is very relevant. This class is really geared to, okay, what is technical analysis? How do we use it? What are some of the basic building blocks around the concept of using a chart? And to me, this is very relevant because a lot of the other segments on Schwab Live Daily use charts. Right after us, we have charting the markets coming up with Lee Bull at 1 p.m. Eastern. And a lot of the other segments use charts and analysis around that. So here is the class to start giving it an education around how to start using a chart, what are some of the important components, what to be looking for. And Mike, um, I appreciate you being on here with me today. One, because I know you are by far an expert on charting because you have the Chartered Market Technician designation, the CMT designation. Can you maybe just tell everybody a little bit about that, and then we're going to get started.
Yeah, Rob, thanks. It's I would first say that with charting or looking at price or charting behavior or however you want to think about it, it is, you're always learning, but there are certain attributes toward looking at the behavior of price or the movement of price that suggest odds or probabilities and directions, and that's really what it's about. It's about not necessarily trying to figure out what's going to happen, but reacting to what already has happened. So this is obviously something that's near and dear to my heart. Spent several years getting what I guess you would quantify as a technical analyst designation, but ultimately it's really trying to read the direction of what has happened and react to it. So
I like that. Read and react. Read and react. You bring up a very important point before we get started. I think a lot of new investors and a lot of new traders get very fixated on trying to predict what is going to happen. And of course, nobody can predict what is going to happen. Fundamental nor technical analysis can do that. So I like how you said it. It's about learning how to read and react and plan. I love that. Love that. All right, let's get started. First thing, some of the disclaimers around this. Yes, today is all about technical analysis. We do recommend that you do not make technical analysis as your sole way of making an investment decision. You need to take into account other perspectives. Okay. Secondly, we will talk and use some individual securities as examples today. We are using those strictly as educational to teach you some of the concepts. They are not recommendations from Schwab. The past performance of a security, unfortunately, does not guarantee that future result. Okay, so you do need to have a plan when things do not go the way you anticipate or the way that you are thinking. Okay, what if you are wrong? Okay, so let us get started. What are we going to cover today? We've broken this down into a couple major segments. One, the first area, it's really, where does technical analysis come from? What are some of the tenets around it? We'll then move into one of the main points of technical analysis and using a chart is how to identify trend. A trend is very important. I would say it's probably the most important thing in technical analysis. Any additional comment around trend, Mike?
yeah, I would think that you're right, and ultimately I'm not sure many people would disagree, just simply based on the idea that the direction of a stock's price or an asset's price has a huge amount of predictive qualities into the general direction that stock's going to be headed over a same period of time. So it's tremendously important, and probably why you see a lot of trend work in any kind of analyst report that you pick up, no matter who is providing it to you.
Yes. We'll touch then on a couple different technical indicators, and even notice in our presentation here, Trend comes before technical indicators. I see many times newer traders or newer investors actually start with the technical indicator without paying attention to trend. And that would be not the correct path to go. So identify trend first. And then we'll look at a few securities within our Street Smart Edge program. We'll look at the chart, apply some of the concepts that we've learned today. So let us get started. Let us get started with this concept of technical analysis. What are we really talking about? Mike, can you maybe walk us through how you speak to clients, speak to individuals as to what technical analysis is and how it compares to that other major tenet of analysis done out there in the investment world, fundamental analysis?
Yeah, Rob, thanks. I think probably the easiest way to break this down, and then I'll expand on that, is really what you see at the bottom of the slide there, right? When to buy and sell versus what to buy and sell. And I think if you were to, really consider what is being said there, and then you think about all the different ways or different times that you as an investor have bought an asset or frankly have sold it. Mostly, let's focus on the buy side first. Really, price is probably one of the last things that you consider. Really start thinking about why you would buy an investment like a stock or an ETF or any kind of asset for investment. Typically it's that fundamental side, really what the company is, what that means to you, how good it is versus its competitors, where it sits in the overall economic landscape. You see earnings and dividend growth. Really what makes that company what it is are really the reasons why, you'd buy an asset. And Rob, I know you have some strong feelings here about that as it relates to, planning and portfolio, but, how it fits in the portfolio is typically one of the first things that you consider. And then once you've divined, really what stock within an industry or a sector, and then what sector fits really, really well in the portfolio, then it becomes technical analysis oriented, where then you decide, when you might want to buy it or sell it relative to its price. Can we get into really, diving into some of these fundamentals and divining what a company's worth? Absolutely. And I think that there's a lot of conjecture around which are the most important and which ones to be matched with others. From a technical side of things, right, we're looking at, all of that real value, how it's being perceived in the marketplace based on the price and how many people are buying or selling it. So that's kind of a funneling effect of how I present this. And again, Rob, I know you have some pretty strong feelings about the portfolio.
Mike, I like how you state that, and I guess I would paraphrase it this way, and correct me if I'm wrong here, but I think technical analysis is the study of investor behavior. The actions that they're actually taking in the marketplace, because to get something to appear on that chart, to get a dot on that chart, you need to take an action by either putting money into the marketplace by buying something or taking money out of the marketplace by selling. And to me, that's very powerful. I think of it this way. People's actions usually speak louder than their words. What people say on TV about a company may not hold any weight, but let's see what they're actually doing with their money. That's to me why technical analysis is something that needs to be taken into account within an investment process.
Yeah, I think that's a great way of thinking about it. And to be fair, I mean, we could probably spend the whole 45 minutes or so on this slide because ultimately there's a lot of different ways that you can shake this up, right? Technical analysis is price oriented. And, again, nobody buys a stock for what it's worth today. They buy it for what it's perceived to do in the future. So you could argue that technical analysis is really, about perceived value or future value, whereas fundamental analysis is always giving you an equation on, something in the past, right? What the company has done primarily to try to figure out, what the value of that company is relative to what you can pay for it. There's a number of different things. I talk to people about being proactive versus reactive. There's that reactive word again that you like so much, Rob. And the idea is that, fundamental analysis is really somebody trying to be proactive, trying to find a good value for something and in hopes that it will be worth what they value it at some future point, versus technical analysis is really just reactive. Something's going up, I want to go up with it until it stops going up, and then I will get off.
There you go. I like that. I like that. All right. So the history of technical analysis, we put up some of the main tenets of technical analysis where it came from Charles Dow and Dow theory. And we're going to walk through each a little bit of these 6 tenets and discuss them a little bit more in depth. So why don't we get started with each of these? We're going to touch on them all. So let's talk a little bit then about this concept of technical analysis and how it relates to Dow theory. Okay, so I'm going to start with Dow theory. Where did this all come from? Came from an individual by the name of Charles Dow. He lived in the early 1900s, late 1800s, creator of the Dow Jones Industrial Average. And so remember that in the time frame when we start thinking about this. So let's start talking through this. So the first main tenet is the averages discount everything. Mike, can you tell us a little bit about how you explain that to clients? What do they mean by that?
Yeah, I think that when you look at what we just talked about, fundamental versus technical, I think that frames this conversation quite well. The idea here is that everything that's known about a security is then reflected in its price. And obviously that couldn't be truer than in the world we live in today, where you can affect change basically any place at any time from your cell phone. So, we take a look at all of these different things. And Rob, I'm sure that you hear from clients on a lot of this stuff, right? Any kind of news item that comes out or environmental factors, future earnings is obviously an easy one. But even, sentiment higher or lower, or political views, or a number of these different things go into, how likely a company is to do well under future forecast. And then the price is reflective of what people think the stock is going to do in that environment. But all of these things, sort of filter or factor into the price.
Okay, that makes sense. So what we're pretty much saying is that, in technical analysis, we make the assumption that our markets are efficient, that as information comes out, it gets immediately reflected in the price of the security. Would that be another way of saying that?
Absolutely, yeah, probably a better way of saying that. But yeah,
Excellent.
as you look at earnings announcements or any economic data, or when Fed Speaker Powell talks, anything that is said that's giving you a glimpse into what the future holds is then reflected in the market.
There you go. Or Mr. Navarro last night saying China's off, and prices go down very quickly, and then a couple of minutes later say, no, we didn't mean to say off, and then they're right back up.
Right.
Absolutely. It's amazing. It's
right?
amazing. Yeah, it's amazing the speed of how that information gets translated into the market today versus even 20 years ago or 40 years ago. Absolutely amazing. Okay,
You
Mike.
can tell that. I was about to say, Rob, you can tell that you and I talk about these things a lot, because again, every slide we probably could spend a fair amount of time on all of this stuff.
Absolutely. So Mike, walk us through the concept of trend in the marketplace and these big terms: primary trend, secondary trend, minor trend. How do you think about those concepts?
Yeah, it's kind of funny because I've done this presentation locally here in the Southwest and in the Great Plains a number of different times, and I always tell people that if you're going to tune us out for any number of minutes, this would be the time to really sort of pay attention, because I think this is one of the most important slides, and frankly one of the most important tenets in Dow theory. And the idea here is focusing in on trend, and trend is something we'll discuss a little bit in that second section, as you mentioned, but I think it's important to define what a trend is before you can really talk about these time frames. A trend is just direction over a set period of time. And what makes that important is that a trend remains intact 2/3 of the time, which means 66% of the time, a trend over a certain time period will continue over an equal time period. So, when you're looking at that, you're basically saying, I have a 66% chance of this stock continuing the direction based on the analysis that I'm looking at, or the time frame that I'm looking at, which is really why this slide is super important. So when we think about this, right, in Rob, you had said it right around 1900s when really these tenants became popular. A big day in the market was like 600 shares traded. So very, very different from the world that we live in today, where you can do that in hundredths of a second. But ultimately, when we're thinking about an illiquid market like that, the primary trend was really the most important aspect. But primary trend, it says months to years. I like to really kind of make things somewhat specific for investors because I think it's important to have some time frames to think about. I typically look at this as being a 1 to 3 year time frame. So when I'm on my, when I'm looking at or searching for the primary, I'm looking at 1 to 3 years. There's reasons for that, and we'll discuss that here in a second. Secondary trend is really sort of the reactions, the corrections within the primary, those stair-step, movements that are so easy to pull out of a chart when you're looking at it. But the secondary trend is typically 1 to 3 months in length. 3 months being sort of that corporate action or that corporate calendar, which really sort of ties into, why that is particularly important. The minor trend is really all about current events. And I know it says hours to several days. Again, I try to make this as easy for investors as possible. I typically look at 1 to 3 days in length. The idea here is, again, you're going to have reactions to things that are happening right now, any kind of news stories or any kind of events that are occurring, today. And the reactions of people making those decisions based on those current events, are typically short in nature. I typically give people the example of, hey, if the Fed makes some level of policy change in their next statement, is that really going to affect the way Chipotle makes a burrito, right? Well, maybe long term if it affects supply chain or what have you, but in the short term, not really at all. But it's certainly going to affect the price of Chipotle stock. So how long that stock price is affected by that news story is going to really depend upon how directly associated it is with its business. So really when you think about these three things, and I know I'm long-winded here, Rob, so I'll give you a second here to talk, but we're looking at 1 to 3 years, 1 to 3 months, and 1 to 3 days, which is a really excellent starting point to define trend.
Yeah, I was going to say if the Fed decision affects how Chipotle makes the burrito, I hope they put a mandate where guacamole becomes standard. So I'm just saying. I like that. I like that. Primary trend, that's your long-term trend. That secondary trend, it's counter to the primary trend and usually a consolidation. But would you say if the secondary trend goes too far in the other direction, it could denote potential primary trend change?
Yeah, absolutely. If there is, if there is an action that is strong enough to change the direction of the trend, and we'll talk about that here in a little bit, then certainly.
Perfect. And then that minor trend, sometimes I've heard that called noise. That can be sort of the noise in the marketplace. Would that be another way of saying that?
Yeah, absolutely. And, again, there's a lot of different ways to think about this, right? I mean, we typically think that the market is cyclical, as you're showing here. But, when you think about a typical economic or now related to a business cycle, it's typically 40 months or 4 years. So that 1 to 3 year chart is really giving you the lion's share of that sort of 4-year spectrum of, moving from, as we're looking at here, bull to bear market or expansion to contraction.
Yeah. So, Mike, maybe talk us a little bit through phases of the market because, I think about what's been going on recently, and we've experienced a lot of this in in a very short period of time. Can you walk us through a beginning person, what you want them to get out of like the phases of the marketplace? What's the most important one or two things to take from this?
Yeah, I think that first and foremost, right, as we think about this, we're looking at price, right, and we're defining price in sort of the landscape of these bull markets or these expansionary, moves higher, and then these bear markets or these contractions lower. But really, again, you're dealing with perception, right? So as we think about, coming off the bottom there on the left-hand side, I hate the term smart money. I feel like it's really people who are looking at something other than price that changes the direction in a stock or a market, because ultimately, specifically at a low, it's really, really hard to say, that something could rebound once it's come off a really, really sharp sell-off, unless you're using something other than price to value that asset or that market. They put this moniker of smart money really as somebody who's using some of those fundamentals to really derive value in the face of really, really sharp selling. So, again, if you're somebody that's just following price, the accumulation phase is probably not something that you're going to participate in as an individual investor, unless you're valuing the stock a different way other than price. Public participation is really when that selling has turned into buying and really created that tipping point. Public participation is really when people take notice, particularly the press. You start hearing about it, on television, in news stories. It really sort of creates that buzz, and that public participation phase, typically, and especially in equity markets, tends to be the longest phase of all of them that you see. Some people will refer to it as a wave, but
Yeah.
it tends to be, one of the longest ones.
I would make a comment on that. In the participation page, traditionally you also see the signs of doubt. Like there's usually a lot of doubt on the way up, that people doubt and don't understand why the market is going up. There seems a disconnect.
Mm-hmm. Yeah, I mean, again, because you're dealing with the public and you have, the people who have taken that fundamental bet probably in fairly early. Again, I think to your point exactly, Rob, you tend with any kind of news story, any kind of short-term data point that comes out, you can get a series of highs and lows, from people sort of taking some quick profits here and there because, again, they can, right? They're dealing with a smaller number of shares than typically, that institutional type of buyer or seller. So again, I think you're right. I think you tend to see a little bit more, smaller reactions.
Yeah. So I like that. I like how you said all that, Mike. With technical analysis, I think you have to come in with the approach that you're not getting the top, you're not getting the bottom, and it's really using other people's money to help formulate those bottoms and tops, and then trying to capture those trends in the middle. Would that be the way to say that?
Absolutely, yeah. Without going too much into every single one of these, if we can just think back to what we talked about in terms of reacting to price action. Again, they're focusing on the market here, but this could be an individual stock. I'm reacting, right? Once I see that the stock is going higher, I buy. Once I identify that the stock has in fact started to go lower, I sell. And the only way I can do that is really to understand how a trend works.
Yeah. For all the computer programs out there, I think that's called an if-then statement. If this happens, then I'm doing that. I like that. I like that. I like how you say that,
Yep.
Mike. All right. So let's talk a little bit about this concept of confirmation. And I know in Dow theory, it talks about how different averages should confirm or validate. We use the word validate on there, how they should confirm each other. Can you talk us through a little bit about what this is trying to tell us?
Yeah, I typically try to oversimplify this for investors because as I think, as we all know, these averages have changed since Mr. Dow actually created them. But, the idea here is that, the industrials are the stuff that is being produced, and the transportation average is made up of stocks that ship that stuff to the people who want it. So when we're looking at both of these things, we want them to be making either highs together or lows together, sort of identifying that as stuff is being produced, there are buyers that want it and vice versa. And when we see these things sort of disconnect from one another, it typically is going to tell you a lot about what's happening in the market. So, if you see the industrials make a new high and the transportations are flat, then, you have this idea that there's an overproduction of this stuff and not enough buyers that want it, and vice versa. So,
Yeah.
I mean, again, it's an oversimplification, but again, these things have gotten diluted a little bit. It's still definitely used and shown, but I think that's probably the best way for people to think about it.
Yeah, I think with today, with today's market, it's really more you want to see some broad-based moves, that if you have just one sector or one small portion of the market doing well and everybody else lagging, that's probably not a good sign of broad economic expansion or economic growth. So it should make you a little bit suspect. So look for something to help confirm. Let's walk to our next topic within Dow theory, and it's the concept of volume and using volume to help us confirm. Can you walk us through that concept, Mike?
Absolutely. Yeah, let me just say one thing here first, though. I know that we're getting a couple of questions here that are sort of specific and related to using charts. And I would say that, again, bear with us for just a little bit. This presentation is a little bit like driver's ed, right? You want to get in and drive the car, but ultimately you got to sit through some study first to kind of know how to use the car. And I would say that, again, we're going to be talking a little bit about this, and we'll answer some questions a little bit later on. But, some of this stuff will become very, very important to how we answer those questions. So we're definitely not ignoring the questions. But, as far as volume is concerned, Rob, I think this is one of the places where an individual investor may be swayed or start to get things a little bit wrong. You had mentioned indicators versus the chart, and again, this is kind of somewhere where the tail sort of wags the dog. And the idea here is when you're thinking about volume, you really should be thinking about validity, right? Another V word. Volume is basically confirming what you see on the chart in terms of direction. And I'll state it this way. If I were in Arizona here today and I were able to do a local seminar, right, which we haven't been able to do here in a while, but let's say I was able to do that and I got in front of 10 people and I got all 10 people to agree that vanilla is the best ice cream flavor. I could sample that. I could put a sample and say, hey, I took a poll and 100% said that vanilla is the best, therefore it is. We then probably have, somewhere between 70 and 100 people, maybe more, listening to us today. I take that poll today, and I get all 70 or 100 of them to say that vanilla is the best ice cream flavor. The question is, which one are you going to pay attention to? Well, obviously, the more people become a more concrete decision, because ultimately there are more of them. So if there's more people, there's more validity in that particular statement. And that's really kind of how you have to look at volume. The more people making the decision ultimately define how valid that decision is. The problem here is that with the 10 people locally here in Arizona, did it make them wrong that there were just 10? No. Right? So you can't say that lower volume is inaccurate. You can just say that it's less valid, which is why you have to pay attention to the chart first and the volume second.
Mike, that is such a great example. I never thought of it that way. And my only comment to you on that would be that the few times I've been out in Hershey, Pennsylvania for Schwab, vanilla probably never fared very well in that survey. That's my only comment. I like that as you get more volume, it becomes a little bit more valid. I like that. Really like that. All right. our last concept within Dow theory is that the trend that we are seeing is assumed to remain in effect. And I know this has a saying that goes along with it that a lot of us as investors have probably heard. The trend is your friend until the bend at the end. Can you maybe just walk us through that concept?
Yeah, I think that this kind of goes again back to us defining trend a little bit earlier, right? Or a trend remains intact 2/3 of the time, which again, from 66% odds of it continuing in the direction that it has been going, right? It's obviously a favorable bet. So you have to know when that ends, right? And ultimately, when something creates, a high that we're seeing there just after that A point, that trend has now changed or started in an opposite direction of what we saw in that line that's being presented from C. I tend to actually have some trouble with this particular slide. First of all, I think that there's a lot of things going on here, but I also think there's several trends that you need to think about. When you move from C to that line just below B, right? That's sort of a longer trend that certainly can be defined there. But when you start to see that area between the two white boxes, right, you can definitely denote that stock is moving sideways there. And then as it sort of breaks above the red line in that second box and then moves toward B, it's sort of a break in that direction in the very short term between those lines. Now, I would actually define the change in trend as when the stock not breaks above A, but actually breaks above the highs that are in that first box. And that's where
Sure.
the C trend changes direction. Okay. Now, we could argue that, at B and at A, it has changed direction in the short term from between the two boxes, but we can't necessarily say that C has changed direction again until it moves pretty much out of that second box.
I like that. I like that. And I think the key around here is having some rules around your analysis around what denotes a trend change.
Right.
And
And I would say that the more time you spend looking at charts, the easier these things are to see. But, I would really, as somebody who's maybe new to some of this stuff, I would call us up, the service lines. We're happy to kind of talk through charts with them and really sort of get a feel for when these trends change, because that is super important to being able to define entry and exit points if you're going to use price on a consistent basis.
excellent. All right. So we touched on Dow theory. Let's now take this up a notch, if I may quote Emeril Lagasse. Let's take everything up a notch. All right. Let's talk about trend, identifying trend. Walk us through this concept of what is an uptrend.
Yeah, well, I think that first of all, let's just say that that uptrend is broken at the end. So this is kind of an interesting slide, but an uptrend is again a series of higher lows. You typically need to have at least three. A lot of people can draw lines with two, but once you have three, it certainly becomes a stronger affirmation of direction. And again, the more points you can put on that line, the stronger the level or the trend that's in play. But again, a series of higher highs on the way up.
Okay, so higher highs, higher lows, and the more points we see on that, the more higher lows that we have, the more significant that trend is, correct?
Correct.
Okay.
And again,
In here,
it's just information for people on this particular slide. I did say that it's broken, and the reason why I said that it's broken is those lows that are sort of in the last third of that trend are then lost as we get over there, right?
Yeah. So I see another big word on this page called support. Can you help everybody watching understand what is this concept of support? What does that mean?
Yeah, so it's typically support is typically looked at in concert with resistance, and really the idea of support and resistance is really just from a price perspective when a stock is thought to be cheap or expensive, right? It gets down to a certain point where in the concept of an uptrend, right, it's low relative to its established growth rate, and that line tends to support value, right? Or people feel like it's cheap relative to its established growth rate. I would argue that whenever you're drawing trend lines up, you draw trend channels up. I think that it's very, very important for somebody to be able to define expensive, right? Especially as it relates to, maybe taking a little bit of profit on the way up. But ultimately, if you were to connect the series of highs, you would have what would be known as resistance, where the stock is resistant to go higher or expensive relative to its established growth rate.
Okay. So support, it gives us an idea of where buying interest might outweigh that selling pressure. Is that another way of
Another
saying
great
that?
way of saying
Okay.
it. Another great way of saying it. Yep.
Perfect. Okay. Let's look at another direction a stock can go, downward. So how do you help clients understand this concept of a downtrend, and also maybe written in there in the red, this concept of resistance?
Yeah, so right now, we're seeing what, is, the classic definition of a downtrend, which is lower highs, right? And again, we have, 3 or more points that are sort of defining that direction over whatever time frame this is. And again, I think it's important to construct time, right? I mean, from an investment perspective, we're always trying to get you a way of thinking about time. But as we look at price, time is super important for defining the odds of direction. So if this were the last 3 months, that stock is going lower and resistant to go higher, right? Or the probability of that stock going lower over the next 3 months is roughly 66%. But in the tune of, with the question that you asked me, Rob, resistance, right? It's expensive at that line relative to its established declining growth rate.
Right. Where sellers have lots of interest in selling and buyers maybe lose their enthusiasm.
Right. Right. And not only that, but they are quicker to lose their enthusiasm as time progresses.
Absolutely. When I see this and I see that downtrend, if I could give a takeaway to new investors and traders that want to buy into downtrends, patience. Okay. Like you said, all the direction and trend is downward. Time is on your side. Patience. There's no urgency to be running out and buying something, because more than likely you're going to be able to get even at cheaper prices down the road. Everything is going the opposite direction.
Here's a quick example, Rob. I mean, so we were looking at the very, if you could go back one quickly to that. So here's just a quick example, right? That stock on the lower right-hand side, right? Obviously, it feels like it wants to go lower. But let's say that it came up, and it came up so significantly that it came up just to about that high, that last high that we saw at the end of that red line, right? Even if it came up there, it's still more likely to go lower than higher. It has to actually go beyond that high for there to be a change in overall direction or probability of direction for the future. So just because something moves, drastically doesn't necessarily mean it's changed direction. It has to, again, kind of go over where somebody has thought it to be expensive before it becomes, relatively cheap.
All right, Mike, let's walk us through this last little one, because stocks can go up, stocks can go down, stocks can also go sideways. Can you just give us the 30-second rundown of what sideways trend is and how you think about it?
Yeah, I mean, it's one of those that people like because there's a defined a value of up and down, right? And I think it's interesting that people like this because, again, between the two lines, there's really no motivation. I tend to tell people to think that this is basically a boat with no motor, right? It's just going where the tide is pushing it. But ultimately, you have something that in the very short term within the two periods, you might have momentum or motivation one way or the other. But in the long term, the stock is really bound by defined levels of cheap and expensive.
Okay. And then eventually we'll have something occur that will push it out of the sideways trend to either start upwards again or start downwards in this. And usually
Yeah,
that's some kind of triggering event.
Yeah, that tends to be my advice when looking at stocks that are doing this is you don't necessarily want to trade inside unless you're very short term. You're really looking for that catalyst that changes the value proposition for most of these investors. Should it be lower or should it be higher?
Perfect. Perfect. Let's take a pause here. Let's pull up and apply some of these concepts to a chart. So Mike, I have the SPY here, and I heard you talking about 3 years. So do we want to look at a 3-year chart? Is that a time frame, or do you want me to go a little bit down to a year? Let's put some information as far as a trend on the chart here for everybody watching today.
Yeah, I mean, I think that it's important if you aren't somebody who uses charts a lot that you sort of use those time frames because those time frames have meaning, right? So 3 years is giving you the lion's share of the primary cycle higher. 3 months is giving you, corporate action or momentum within the corporate calendar, and then the last 3 days is telling you, what the position is doing relative to current events. So those are really 3 really good time frames.
Okay, so how would you classify um, the trend over the last 3 years in SPY?
Yeah, well, first of all, it was broken a couple times back in at the end of 2019, and then of course in the most recent decline. But the market has moved back into that bullish trend. So I wouldn't necessarily say that this is remained intact, but it has kind of gone back into that bullish phase. So again, your odds over the next 3 years would be 66% of the time the market's going to be higher over the next 3 years.
Okay. Can we maybe take a look then? Maybe we go a little bit shorter term then and just look at the last year. I'll get rid of that trend line that I just added on there. So if we were to draw a trend line just from the lows, if I'm going to go back in there, I'll draw that trend line. So we're connecting the low with the higher lows that we've had. So that would be our trend line upwards.
Mm-hmm. Correct.
Okay. So you would say from a technical point of view, if we start getting below this trend line, that would be a little bit sign of warning. But more importantly, the low that we had here at the middle of April, that if we started getting below that, that would be a new lower low as opposed to a higher low.
Right, that would be a change. That would be a change in direction over that period of time. And I would argue that both that white candle that you're showing there and the other white candle higher that it seems to be bouncing off of, right there. So those can be 2 areas where you could spot possible weakness. The guy who taught me how to look at charts, always used to say you draw trend lines with a crayon, not with a pen. Because again, you're not going to get these points to line up exactly, but it's important where they line up.
Yes, that's an important point for all the engineers out there. It's not, we don't have to get to the second or third or fourth decimal point. So it's a little bit more art out there. Yeah, I like that. Let's maybe, let's look at an individual stock. Probably one of the most talked about stock that over the last, call it 10 years has been Apple. Uh, what's if I draw the trend here? So we had some lows over the last year on April 23rd. And would that be the correct way to draw the trend line up that it has been in since those lows? So the last 3 months.
Yeah, I mean, I would argue that that bottom of that wick is at the bottom is probably not the best place to start. I would start at the bottom of that red candle at the very bottom, and that would probably give you a trend line that's closer to the lows for most of that trend. But ultimately, right, exactly. So if you were to start connecting them there, I think you'd get a stronger trend line or stronger understanding. But again, it's just direction, right? Rob, real quickly, because I know we're pretty much out of time here. Do you have moving averages that are on that chart?
I do. We can add them. Which would you like to add?
Can you put on just put on the 20, or excuse me, the 200 and the 50?
So the yellows are 200-day moving average, and the red is the 50-day moving average. Mike, tell everybody real quick in 30 seconds, what is a moving average?
Moving average is just average price over that period. So when I ask for a 50-day moving average, it's looking at all 50 days closing and averaging them using the 50.
Okay, so the average price of Apple over the last 50 days has been $311, and the average price over the last 200 days has been $279.
Right.
Okay.
So the important point here, and I'm going to make this super simple and super quick. The reason why I'm showing you moving averages is not to give you buy and sell indications, but to give you direction of trend. So if you're looking at that red line, very, very easily you can tell that over the last 50 days, that stock has been trending higher. Over the last 200 days, that yellow line, the stock has been trending higher, which again gives you odds of direction over those periods. It's as simple as that.
Yeah,
so if you're somebody
like
that doesn't or isn't comfortable using trend lines, put on moving averages. It will define odds of direction over whatever period or average you're using.
I like that. Keep it simple. Look at the direction of the moving averages. Look at the direction of the stock, the trend of them.
To be
Mike,
fair, I oftentimes just simply take the price off of it. I'll turn that price action to black to match the background of the chart, just so I can look at the moving averages without the bias of the chart price, and then I can define the odds of direction without even looking at price action. Great way to do it to start off.
That'll be in our next technical analysis class.
All right, sounds good, Rob.
Mike, thank you for being on here today. To me, this is really important, just getting that little bit of background around when we look at all these charts, what are we looking at? Why are we looking at it? What are the basics that you need to understand as you go apply this type of analysis in your investing and trading? Okay. Thanks for the questions today, everyone that watched. Please let us know if there's additional areas that we can help with. I know in our Learning Center on the Schwab website, under the Research tab, we have a whole trading path on technical analysis. It's a whole class that you can take to learn much more in depth about all the concepts that we talked about today, and even take it to additional levels for yourself. Reminder, coming up next, Charting the Markets with Lee Bohl and Skylar Marin. They will take application of everything that we talked about to different securities, different sectors in the marketplace, give you some analysis around it. Okay. Last one here. Yes, I know you were late. Yes, these slides are available in the resource section on Schwab Live Daily. Just go up to the top of the page, click on the resources. You can take a look at these slide resources also.